Balancing acts. Learn the art of asset allocation.
You know, Sarah, I have always felt pretty confident about my investments. I have been diligently putting my money into stocks, and I have seen some returns over the years.
That's interesting, Mark. I'm more on the cautious side myself. I prefer investment options like bonds and fixed deposits because they are not as volatile and risky as stocks.
But investment in equity is important to outpace inflation over the long term, right? Otherwise, your investments will keep losing value.
Yeah, but it's all about being protective of what you have got, right?
It seems you are both at different ends of the investment spectrum. Mark favors stocks for growth, while Sarah opts for relatively lesser risky options. Have you ever wondered if there's a way to optimize your investments and strike a balance between risk and reward?
Interesting. How do you balance that?
Allow me to clarify how risk and reward work together. Risk is like a double-edged sword. If you choose investments with low risk, they might not grow much, which could slow down your progress towards financial goals. On the other hand, high-risk investments could put your goals at the mercy of uncertain market swings. So, it's not wise to put all your money into one type of investment without knowing the risks and potential rewards. The trick is to balance things out by investing in different types of assets with varying risk and reward by diversifying your portfolio. This strategy is called asset allocation.
Asset allocation? Tell us more.
Imagine asset allocation as a well-balanced meal. Just as a balanced meal combines proteins, carbs, fats, and vitamins for optimal nutrition, asset allocation mixes various investments across different asset classes such as equity, debt, gold, real estate, fixed deposits, and more. Just like a balanced meal is vital for your good health, asset allocation is vital for your portfolio health as it brings along several advantages. Each year may have different winners where you see one asset class performing better than others. Asset allocation helps you to capture opportunities for growth in different market conditions. It helps in managing the impulsive behavior of investors, which are often driven by greed and fear due to market volatility, thereby aiding their long-term objectives. It prevents your portfolio from becoming overly focused on one asset class. An ideal portfolio isn't heavily weighted towards just one asset class, but rather benefits from the combined performance of various asset classes.
But how do I find the right asset allocation for me?
The asset allocation mix for you will depend on three factors: your goal orientation, risk appetite, and investment horizon. You must understand that every asset class has a role to perform in your portfolio. For short-term needs and emergency requirements where you take relatively less risk, debt may be the preferred choice. For medium-term goals like buying a car, a balanced mix of asset classes would be wise, as you can take some risk. For long-term goals such as retirement, higher exposure to equity might be a good choice, as higher risk over the long term may lead to capital appreciation.
So, I do the asset allocation once, and I'm sorted forever?
Well, Mark, asset allocation is an ongoing process. Therefore, regular portfolio rebalancing is essential. Understand this. During market fluctuations, certain asset classes may outperform or underperform others. Without rebalancing, your portfolio could stray far from your target allocation. Thus, regular monitoring and rebalancing to realign your portfolio with your financial objectives ensures it stays on track. For your ease, there are several hybrid mutual funds available in the market which provides different asset allocation mixes. You can choose these funds basis your goals, risk tolerance, and investment horizon.
This discussion has been enlightening. Alex, how do we start?
It's straightforward. 1. You may consult a financial advisor. 2. List down your financial goals, investment duration, and risk appetite. 3. Invest in the suitable asset allocation mix. 4. Rebalance the portfolio from time to time. By following these steps, you may have an optimal portfolio. Take the first steps now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.